Wall Street got an inflation report it could celebrate. July consumer prices rose 0.1% from June. Annual inflation cooled to 3.4%, and core inflation eased to 2.5%. Stocks moved higher after the release, and Treasury yields fell as investors saw less pressure on the Fed to raise rates in September. In market language, that counts as good news. In grocery store language, maybe keep the champagne on layaway. Now look at Paychecks. Average hourly earnings rose just 0.1% in July and 3.2% from a year earlier. Annual wage growth was therefore running below the 3.4% pace of consumer inflation, and Business Insider notes that inflation has outpaced wage growth for 4 straight months. Your paycheck can still be bigger in dollar terms while making less progress against prices. That is not a nominal pay cut. It is a purchasing power squeeze. So why can Wall Street celebrate the economy households dislike? Markets care about direction, expectations, and the next policy move. CPI came in where economists expected. Headline inflation cooled from 3.5%, and core inflation eased. Investors feared a hotter surprise that could push the Fed toward another hike. They did not get one. The bar was not inflation solved, it was please don't set the bond market on fire. Lower perceived rate risk matters because yields feed into financial conditions and valuation. When investors see less pressure for higher short-term rates, bond yields can ease and growth stocks get a friendlier discount rate backdrop. That does not erase the cost of groceries, rent, insurance, or energy. Wall Street prices the next decision. Families pay the current bill, and inflation slowing is not the same thing as prices going down. Food prices were 3.0% higher year over year, while the broader CPI was 3.4% higher. So the market can cheer a cooler inflation rate while consumers still face a price level that has already climbed. The bull sees a softer slope. The grocery receipt remembers the whole hill. The next test is producer inflation, scheduled for August 13th at 8:30 a.m. Eastern. A hot PPI could bring rate hike anxiety back. Another mild print would strengthen the case for the Fed to stay put. The takeaway is simple. This was better news for markets, but that does not automatically make it good news for household purchasing power. Price is the surface. The gap between financial conditions and real-life cash flow is the message.